PI Industries has outperformed the peers in that space by a margin in 2019 to trade near its record highs. Now, Yash Upadhyay is staying by to tell us what's working for the company. Yash, amongst all the conversation about SRF, Navin Fluorine, etc., PI Industries has been a rank performer.
Absolutely, Neeraj. So on a year-to-date basis, the stock has rallied almost close to 70%, which is substantially greater than the likes of SRF, Aarti Industries, for one, which had come under severe pressure after it cut down its earnings guidance post the first quarter results. Even the likes of Vinati Organics or the more popular specialty chemical names. Now, this is mainly on account of the strong earnings growth that the company has reported last year as well as in the first half of this time around. So take a look at the earnings trend and look at their revenue growth in FY16 and FY17. So these were years of moderate revenue growth for the company, growth of anywhere between 8 to 8.5%. But FY18 was particularly dampening for the company and for the entire industry as well, because we saw an absolutely flat top line growth in FY18. But then the last 2 years, or at least the first half of this year and FY19, they have been extremely positive. We saw a 25%, near 25% growth in top line for PI Industries, and this time too in the first half they have reported a strong growth of 25%. Now, this is largely led by the strong growth in its custom manufacturing and synthesis business, which is the CSM business. Now, that contributes a large chunk of its overall revenues. Almost 70% of its revenues come from this business. It has hovered around that mark for the last several years. And take a look at how the CSM business has been doing over the last several quarters, going from the levels of -4% in the second quarter of FY18. We've seen a big jump as far as the growth in the CSM business is concerned. Not just has it managed to outperform the growth that it has been doing over the past few quarters as well, but the kind of the extent or the magnitude of growth is as high as almost 59%, which the company reported in the first quarter of FY20, and it has been steadily gaining from almost 33% to as high as 59% in the first quarter, and then again a 52% growth coming in the second quarter. So strong growth momentum seen in its custom synthesis and manufacturing business, which is also the high margin and value added business of the company. Not just that, there is strong order inflow as well, which gives visibility in terms of revenue growth going forward. So their current order book, that stands at somewhere around $1.4 billion as of the end of second half of FY20, and it has managed to steadily grow as well from the levels of almost $1.1 billion same time last year. There is positive as far as the management commentary is concerned as well. Despite seeing most of these global agrochemical companies cut down on earnings estimates, PI Industries is one player which has said that it would go out and do a 20% plus growth for FY20. Even if things go down, even if things don't go down well in the second half, they would be able to do a 20% plus for the full year of FY20 and going forward in FY21 as well. What gives them this confidence is the extended monsoons, which has improved prospects of Rabi sowing. They have also come out with a new product in the wheat category, which is called Aquira, and that is likely to do well in the second half of this year. Higher contribution from the CSM business. We've seen that it has consistently hovered around 65 to 70% over the previous years, but going forward the company expects the share of CSM business to rise even further, and that should aid in margins expansion of anywhere between 80 to 100 basis points over the next 2-year period. They have maintained their capex guidance of 400 to 450 crores rupees for FY20 as well as FY21. They commissioned a new multi-purpose plant in February of this year, and they are hopeful of commissioning 2 more plants by the end of FY21. So they continue to remain focused on expanding their capacity, and the exports business that is likely to offset most of the degrowth that we've seen in the domestic business, which has been posting a negative growth for the last 2 quarters. That apart, well, there are concerns with respect to valuation, because given the substantial surge in the share price, the valuations do look stretched at the current moment. Its FY20 price to earning multiple stands at almost 49.2 times, which is at a premium to its 5-year average of 33.4. Not just that, most of the analysts which track the counter too have now turned slightly cautious. So from 21 analysts that had a buy rating on the counter at the start of the year, that number has gone down to just 15, and we've seen more number of holds as well as sells come in. The return potential on the counter as of now is a -2%, because the 12-month target price for the consensus of analysts stands at somewhere around 1,434 rupees, which is a 2% drop from where the stock is currently trading.